It would be a brave individual that would bet against the Labor Party and Bill Shorten not winning the next election. That next election is looking likely to be in May, considering that the budget's been pushed forward to April. Part of Labor's policy proposals, and there's been quite a few of them, is changes to taxes on property and the property marketplace in general. They've got a three-pronged approach that they've been pushing on their Labor website and by policy release. Those three items are one, to ban limited recourse borrowing arrangements, or basically borrowing to purchase property within the superannuation environment. Two, they want to remove negative gearing, i.e. claiming a loss against your property against your individual name on established property. They'll maintain the status quo on purchasing new property, i.e. you can claim that loss against your individual tax returns. So effectively quarantine the loss on established property against future capital gains. The third pillar that they want to release is to reduce the capital gains tax or the capital gains tax reduction or discount on purchasing a property. So if you buy any asset, shares, property, or business, and you own that asset longer than 12 months, then you only pay tax on 50% of the gain, i.e. 50% gets added to your assessable income and you pay the corresponding amount of tax on it. Labor's proposal is to reduce that 50% discount to a 25% discount, effectively then paying 75% of the gain you make on the sale of that asset and paying tax on it at your assessable income rates or marginal tax rates. Out of the three proposals, considering the property market has come back since those announcements have come through, and considering the policy effects that may flow from each of those individual announcements, the one that I am confident will get up, or they would pass or drive, is actually the reduction in capital gains tax. And the reason I believe that's the case is because it's a deferred pain or a delayed pain. Effectively, people won't notice the extra tax they're paying on that property, on the gains they make in the future, until they sell it. With a lot of our clients, we talk about buying for the long term, 10 years, 15 years, 20 years, and people won't notice that they've paid extra tax until they've sold it and complain about the tax, which means they've made a good gain, but they'll notice it then. So it's our very strong view that if you're considering purchasing a property in the short to medium term, you both have market conditions in your favour in the sense that property prices have come back, and you have this impending event that Labor are likely to win the election, and they're likely to make some changes to property tax rules, and one of those is potentially going to cost you more tax in the future. So there's an impending event or value in looking to push forward your purchase and buy before May. Labor's been very strong or unequivocal on their website to say that the rules that they've proposed to come in won't be applied retrospectively, and that they will apply these post-election. So there's that deadline or event that makes it worthwhile talking to us to have a look at the circumstances suit you, that you should be looking to purchase a property now to reduce potentially the tax you pay in the future. When you make that calculation over 10 or 20 years on the capital gain on a property, it is a substantial difference to what you walk away with, which is going to help you fund your retirement. So if you're looking to act, chat to us now. We'd love to catch up with you and see if we can help you out.